A global pandemic caused the stock market to drop over 30%, wiping out a lot of the gains from the people who invested near the top. The market is still not back to all-time highs, and a lot of people are concerned it's going to drop again. So what if there was some way to protect your investments for the next drop or during the next drop? Welcome back to the channel. I'm Jacob Fisher, and I'm not an investment professional, so I hope that you are just watching this for entertainment purposes only. Today we're talking about hedging positions with options to hopefully save you a bit of money during the next market downturn. Let's tap that like button because I like saving money, and I would hope you also like saving money. There are two ways to do this. One is buying options and the other is selling options. It is possible to sell covered calls to protect your position. Think about it like this. You buy calls because you think the stock is going to go up. So if you sell a call, you think it's going to go down. However, a lot of people who sell covered calls don't expect their position to be exercised. So they're really just trying to collect a premium while selling covered calls while the market is going up. I think overall, selling covered calls to protect or hedge your position is a bit riskier than just buying puts. So for this video, we're going to stick to just buying puts. There are two options with put options. They both help you to protect your losses, but it just depends what kind of stock and what kind of thing you're trying to hedge against to determine which one you should choose. The first option is if you're doing a riskier investment and you're hoping to limit your potential losses if the stock were to go to zero, for example. Tesla would actually be a really good example of this in this case. Let's say you want to buy Tesla right now, even though you watched my previous video on bubbles and Tesla's at $1,500 right now. So let's say you get it then and you think it's going to go up to $2,000 a share in a single month, because honestly, nothing is unrealistic for Tesla at this point. You spend $150,000 buying 100 shares in hopes that Tesla is going to go up to 2,000 and you're going to make $50,000 in a month. That's a good return, but you don't want to lose $50,000 if it goes down. That's not your exit, let's say. Here's what you can do. You can limit your risk by buying the 1250 put for Tesla. When you buy a put, that gives you the option to sell 100 shares of Tesla at that price. Currently, the 1250 August 21st puts are selling for $20, which means you would need to spend $2,000 to purchase that contract, because 20 times the 100 shares is $2,000. A few things could happen now. Tesla could go up to your price target of $2,000 and you could sell for your $50,000 gain minus the $2,000 that you used to purchase the option, leaving you a total return of $48,000. That's pretty good in a month, I have to say. Tesla could also go to $1,000 a share and you wouldn't lose $50,000. You would only lose $25,000 plus the $2,000 you spent on the contract. This is because you bought the 1250 puts and you can exercise your put to sell 100 shares at $12.50, limiting your loss to $25,000 plus that premium. Of course, Tesla could not go below $12.50, it could not go to $2,000 or $1,700, and you could just be out your premium price, but at least you prevent your overall risk and limit it to a certain point. You could at this point buy another put and get more insurance, or you could just do whatever you want. Really, it's your position. It's just up to you if you want more insurance or if you are okay with just selling at $12.50 if it hits that point. Or hopefully making more, because Tesla is wild and it just goes up sometimes. This option hedging strategy protects your investment up to a certain amount, whatever strike price that is that you set for it. In this case, your max loss is $27,000, while your max gain would kind of be infinite-ish depending on how high Tesla goes. But either way, your gains with your price target should easily outweigh the losses that you could potentially take. Let's get into how you can hedge your whole portfolio though. Let's say you have a collection of stocks in your portfolio that you want to buy or that you have bought and you're holding long term. This is for very long term, years. You could buy puts on the overall market to help offset your losses in a market downturn or market crash, similar to what we saw in March. If you have a $100,000 portfolio invested in the overall market, you could just use SPY in this example, which is a great ETF that tracks the whole market. You can use SPY to help hedge your portfolio in this case. SPY is a great thing to use when it comes to options because it is super liquid and there are always options being sold on it. There's options on Monday, Wednesday, and Friday, and then monthly, weekly. There's just options all over the place, meaning you have a slew of options to choose from for options. So how do we do this? How do we determine how many puts we need to buy to hedge our $100,000 portfolio? Firstly, we have to take $100,000 and divide it by the current price of SPY, which is at $323 a share right now. That would leave us with 309 shares. That means you would only need to buy 3 contracts because, again, one option contract is 100 shares. So 309 divided by 100 is pretty much 3. To decide which strike price and date you should get, now I would typically go a month out and 5 to 10% down because you're trying to protect against major market downturns. I would be okay with being down 5 to 10% in my portfolio if it was a long term, because generally it's going to go back up at some point in time. So I'm holding this portfolio long term. 5 to 10% loss isn't awful. I mean, it's not ideal. And of course you can adjust your risk levels accordingly. Maybe you only like a 2 or 3% loss. You can still do that very easily. For 10% down though, that's a strike price of $290 and 5% is $306. Now the 306 puts cost $2 while the 290 puts cost 77 cents. That would be $200, again, times 100 times the 3 that we need to buy, or $600 for the 5% down. Now with just $600, you can consider that little insurance to cover your portfolio over the next month for any losses that go below 5%. Or 10% or 3%, just depends on whichever one you chose. Let's say the market drops 15% in the next month. Your portfolio is now at $85,000. That's a $15,000 unrealized loss. SPY would be at 274, and your 5% option contract would be worth at the minimum $48 a contract. Now I got that by subtracting the strike price minus the current price of SPY. You can do that generally to get a base level for option pricing contracts. Of course, if your option is $48 a contract, multiply that by 100 and by 3, meaning your option would actually be worth $9,600. That would increase your portfolio value $9,600, bringing it to $94,600. That's a much better loss than the original $15,000 loss we were thinking in the beginning. If SPY continues down, your portfolio would decrease in value, but your option would increase in value because every dollar down that SPY moves, your option contract should go up by $1 more. This is an extreme example, but actually it's not super unrealistic, because after that initial drop in January, back in March, SPY actually dropped around 30% in just 20 days. This would be a great way to hedge your overall portfolio and hopefully just save you a ton of money and potential losses. The market is always moving, so definitely don't go out and hedge your portfolio right now because it's going up and you don't know what next week will bring. Generally, you would wait for some sort of decline or news to hit before you hedge your portfolio. This isn't something you buy every month for $600. You don't need to do that. Of course, the market might go up or it might not do anything, and you could be out $600, but it's a lot better than being down $15,000 and having no safety net. Let me know in the comments what you think of this strategy and if you would implement this, if your portfolio could take it or handle it, or if you invest in the overall market. I want to know. I upload videos on Monday, Wednesday, and Friday on travel and finance, so if that sounds like something of interest to you, make sure you subscribe down below. Thank you so much for watching, and until next time.